Very happy to welcome to Forward Guidance Vítor Constâncio, the former vice president of the European Central Bank and the former governor of the Bank of Portugal. Vítor, thank you so much for joining us. How are you today?
I'm fine, thank you. And thank you for inviting me to join your audience.
It's my pleasure. Vítor, I want to start off. How would you assess the European Central Bank's efforts to fight inflation within the euro area? European rates, I think, 4%. Very recently, were at zero. For much of your tenure at the European Central Bank, they were at zero, and that is to fight inflation. How would you assess the sort of motivations to raise rates to fight inflation, and how would you assess their success so far?
Well, of course, when inflation spiked, in the case of the euro area, mostly due to external price spikes, energy and food stuffs, as the record shows. When it spiked, of course, the central bank had to increase rates after a certain point in time. Initially, it seemed just like an external supply shock, which does not require per se an immediate reaction from monetary policy, as we know. But of course, it indeed increased even more and then started to impact domestic prices and the feedback loops that exist domestically, both in terms firms passing on or even exaggerating the increase in costs or wages trying to catch up, which didn't happen during a long time in Europe. But nevertheless, it was unavoidable. So the ECB started to increase rates in last July, July of last year, and the Fed in March of last year too. I think the Fed was very late because inflation exceeded 4% already in April 21. And whereas in the euro area at that time, in April 21, was at 1.6 only. And then the ECB could have started in March of last year instead of July, but that's not really a dramatic difference. As you know, interest rate policy leads to a time lag to really produce effect. So inflation is going down everywhere, and it's in a path that would lead in time to an acceptable inflation rate. And in that sense, the monetary policy of the ECB has provided an impulse to that disinflation that we see occurring.
And so you said that inflation in the euro area has a lot to do with rising energy prices, not demand. Would you say that's true in the US as well, or would you draw a distinction there?
No, there is a strike distinction between the two processes. Indeed, the fiscal policy in the US was very expansionary even before the pandemic started. And then also after that, it was much more expansionary than in Europe. And that created a situation of demand pressure that didn't exist in Europe at that time, and therefore the 4.1 inflation rate in April of 21 was already due to that. Very recently at the ECB forum in Sintra, there was a paper presented by Silvana Tenreiro that illustrated that very well, using a model, of course, to take out the spikes in external prices, both for the US and for Europe. It shows very well that in the US it was overeating due to domestic demand that started the process, not at all in Europe. And she had also another chart that was very illuminating. Using the same model, she analyzed what would be the core inflation in the euro area and in the US if those external price spikes would not have occurred. And the result was very striking that core inflation right now in the euro area would be at 2.5 and in the US at 6%, showing in fact the total difference of the two processes of inflation.
So can you walk us through that? Because right now, so headline inflation, which includes energy, spiked, close to 10% in
Yeah.
Europe, and then gone down because
Yeah.
energy prices have fallen. But core inflation is now at above 5%. So some people would call that sticky inflation, not including price of energy. What you're saying, you're referencing a paper. Could you elaborate on what you found there?
No, there is just that using a model, she calculates what would have been the core inflation rate now in both areas if the initial external price spikes of oil would not have occurred. And she finds the numbers I mentioned, 2.5 for the euro area and 6% for the US, showing, of course, that in the US it's much more a question of domestic demand and process than in Europe.
So if there was no oil shock, a natural gas shock, core inflation would have been muted in Europe. But there was, so core inflation rose. So inflation broadens out from, even though the original shock is just from energy. What is the role, what is the job of central bankers when if the cause of inflation is energy completely outside of their control, but it broadens out to become a core inflation issue and demand? I mean, certainly perhaps not to keep interest rates at zero and say, oh, it's
No,
just
sure.
demand. It's just energy, right?
No, of course not. And by the way, in the euro area, the actual policy rate was the deposit facility rate, which was at minus zero point 0.5 or 50 basis points, not at zero. And that was the real operational policy rate. But you are right, of course, that with that scenario and the transmission from the external spikes to domestic inflation required a reaction of monetary policy by increasing rates. And so far, the ECB increased interest rates by 400 basis points or 4 percentage points, which in a year, it's really a very quick, significant increase in policy rates. The US did a little more, but just a little more. And so both central banks and others are reacting properly to the inflation challenge, of course.
Right. That makes sense. So do you think that the current 3.5% interest rates for Europe is appropriate? Do you think the ECB should go higher? If you were still sitting in that chair, what would your vote be for interest rates?
I would go for a pause after the level it was reached. For various reasons. The monetary policy takes time to produce effect. And so one should never just look to what is right now inflation, but should have a view about the future. Monetary policy is necessarily forward looking, both because monetary policy takes time to produce effect, but also because the objective of monetary policy is defined for the medium term. It's not for the next quarter. So monetary policy must be forward looking, and a view has to be taken about the future. And so it is to be expected that the level already attained by interest rates will continue over time to produce an effect on inflation. Secondly, it seems that in Europe, a recession is coming. There are many indicators right now, more so than in the US, although in the US there are also indicators that with time a recession will come. No one can be sure about the depth of that coming recession, but it's coming. Um, We have in the case of euro area the same type of indicators you have in the US, only more so. The inversion of the yield curve, the leading indicators pointing also to a negative growth recession, PMIs that are below 50, and have been in manufacturing below 50 for more than a year now, consistently. Germany has a very weak economy right now.
Germany has a weak economy.
Yeah, very weak, the weakest in the euro area right now, with very severe indicators. The manufacturing PMI at 40 only, retail sales at -8 compared with last year, factory orders -11 in May. So it's really very weak, and that will, of course, have spillovers for the other countries in the euro area in view of the importance of Germany in the European economy. So all that points to a coming recession that in our case, I think it will come this year for sure. And that's important to see what the effect will be on including on the core inflation. By the way, another indicator which is meaningful in May, and for the first time in years, the producer price inflation was negative in the euro area. Just to give you a number, in July of last year, it was at 41%, the producer price inflation. And in May, it became negative. So that's an indication also that for the industrial goods, non-energetic industrial goods, this implies that their price are coming down, and that's part of the core. Just to underline that aspect. And with the coming recession, also wages will become more subdued than so far, even that on average wages in our case have been growing below the inflation rate so far, and that not per se put additional pressure on the inflation process. So all that leads me to be in favor of a pause, a real pause, not necessarily the end, but a real pause, not a skip or any other way of naming it, a real pause. To see what is coming. I think the numbers for September will be meaningful in that respect, including for the core inflation. And by the way, we should not overemphasize the importance of the core, because of course in the end what counts for the consumers and for the economy is what is happening in total headline inflation, of course. Core is just a way, and in the case of just deducting energy and food from the total inflation is not a very good indication or indicator of core, the real structural component of inflation. Both the Fed and the ECB have other ways of calculating the core. And these other ways, with analysis of principal components or dynamic factors, lead to a core inflation which is 1 percentage point below what is indicated just by deducting the inflation in energy and food. So one has really to have more information, and I would go for a pause for a little while to see how these evolves for all the reasons I just enumerated.
Thank you for laying that out. So you would advocate for a pause. So the U.S. economy has been surprisingly resilient to interest rate hikes, whereas the data you just laid out in euro, it shows not so much, and the euro area could be entering a recession. How do you think the appropriate level of interest rates and restrictive level of interest rates might change with Europe's economic outcome? And if there's a mild recession in Europe, do you think rates could stay at 4%? Or if there's a more severe recession, might it be necessary for the ECB to actually cut rates?
Yeah, I'm not anticipating a severe recession, really. In spite of the numbers, I mentioned the numbers point to a mild recession, which will be enough to help breaking the dynamic of core inflation, of course, which is relevant. So I think that the ECB not necessarily would have to quickly start reducing rates. And very likely, in terms of just what one could expect, that the ECB would keep the rates at that level for a while, just to be sure, until inflation really comes down in all respects. But with this prospect of a recession, even if a mild one, I think that in the second half of next year, we will see inflation really going down by the end of next year, close to 2% already by the end of next year, if this scenario will materialize and if the ECB keeps rates at the present level for quite a while.
Thank you. You said that the Federal Reserve was late to raise rates. I believe the ECB started to hike rates after the Federal Reserve. Was the ECB itself late to hike rates? And can you speak as someone who was formerly in that seat as vice president of the European Central Bank from 2010 to 2018? Is there a certain amount of pressure on the European Central Bank to follow what the Federal Reserve does? If the Federal Reserve keeps interest rates at zero, we can keep interest rates at zero. If the Federal Reserve hiked, now the ECB may have a little bit of pressure to hike. Or is it solely focused on the intra-euro area monetary concerns and inflation?
Yeah, well, it's not so simple. Well, in the first place, of course, what the Fed does in view of the importance of the US economy in the world economy and the spillovers of whatever the Fed does to other countries, which are quite well known. Of course, other central banks, even big central banks like the ECB, cannot totally ignore what the Fed is doing. The Fed is in command of the monetary and financial world cycle, and that's a fact that is well illustrated. But that does not imply that other central banks or the ECB have to exactly copy what, or even close copying what the Fed is doing. Well, take the example that the Fed started QE in 2008 and the ECB only in 2015. So there was no following at all in that important instrument that in the end, of course, we had also to use. When inflation became negative for a few months and the risks of deflation were increasing significantly. So the importance of what the Fed does cannot be ignored by others, but they don't have to copy. When I say, for instance, that the Fed should have started before, I refer to the fact that in April 21, as I mentioned already, inflation in the US was 4.1 and 1.6 in the euro area. In April, it was 5.4 in the US and 1.7 or 8 in the euro area. So by then, it was clear that an inflation process had started for domestic pressure reasons in the US, not for external price spikes that had not occurred significantly in the spring of 21. And in the euro area, we had inflation below 2, so no reason to think about any increases. Indeed, the inflation only went over 3% in Europe in September of that year. And then we didn't know, no one knew what will be the development of the international prices. And of course, what changed the situation completely was the invasion of Ukraine in February of 22, and that was a game changer. Completely, because the spike in food prices and oil was immediate and very, very sharp. And so that's why I think the ECB could have started increasing rates in April of 22 instead of July. But by then, the Fed should have had started increase long before, in my view. So you see, it's not linear, but there is an influence because in third point, both reflect what is the world situation, and inflation after the beginning of the Ukraine war was clear that was a worldwide phenomenon. So central banks had to act in the same direction.
The European Central Bank, alongside the Bank of Japan, is noted for its adoption of negative interest rates, not just going to zero, but the price of money actually going negative. As someone again who was there at the time, could you describe the thinking of the European Central Bank in saying, we lowered interest rates to zero, but it's not enough. We have to go lower. Were you in favor of that? The proposals at the time that it happened, and in retrospect, was a decade of history. Do you think that what were the learnings? Does it works, but not as much as people think? Oh, it has very bad consequences. What do you think
about negative rates? Well, it happened initially as a sort of inertia. As I said, we had in 2014 we began to have a few months with negative inflation rates. The pressure was big and the risks were also big. So in June of 2014, we decreased the main refinancing rate, the policy rate, to zero. And we operated a corridor system with a deposit facility rate below the main rate and a lending facility with a rate above the main rate. And so when we went to zero in the main rate, automatically we had the deposit facility rate negative initially at minus 10 basis points only. And as a result of the general policy of liquidity provision to the banks, there was excess reserves in the system already then, which led that the money market rate became very close to the deposit facility rate, which in practice became the actual policy rate. Also by then. So indeed, we started to have the minus 10 basis points. I went on board with that initially because it was necessary to lower rates, and the corridor system led to that. But later on, I was not a big fan of continuing to decrease the deposit facility rate and going into more negative territory. I was still am not convinced of the efficiency of the measure, which relies too much on the expectations process to have an effect, because the main idea was that by proving that the short-term rates could go negative, that would have an influence on the expectations for the medium and long-term rates in the yield curve, and that in itself would be expansionary. Well, it relies too much in the mechanism of expectations for that to really be totally efficient, and it creates, of course, other problems to financial calculus to go negative in a very visible way. So by this, you see that initially I was on board, but I was not a fan of going as negative as in the end the ECB went to minus 50 basis points.
and that's because it just ceases to stimulate once you go below zero, or because there are side effects that are not?
Oh, there are side effects, of course. The expansionary effects are not as clear or as convincing the way I see it. And so that was and still is my sentiment and my assessment of the policy. And I hope that we won't have any circumstances of the same nature that would lead central banks to go there. Because it was not just the ECB, as you know. Sweden, Switzerland, others, Japan you mentioned, and so on.
Right. And sort of the textbook definition of how central banks can impact inflation and the economy is high interest rates discourage borrowing and they encourage saving money. So the lower interest rates go, the more stimulative that is. As you know, and as viewers of the U.S. economy can know, it's a little bit more complicated than that because the U.S. economy has been very resilient. Rates are at 500 basis points. The stock market's on a tear. How would you say that sort of simple theory worked or didn't work, or was proven or was not proven throughout your long and tenured career?
Well, monetary policy, meaning interest rate policy, is very asymmetric. And history, monetary history proves that abundantly. Meaning by that interest rate policy is not very effective to fight against recessionary phases in the economy. Just going to zero or even negative does not per se stimulate, for instance, investment. In that sort of recessive situation, investment is much more influenced by the expectation of firms about future demand. And so the interest rates have not a very visible effect on investment, for instance. And that's what happened. That's why central banks had in the end to use QE and other instruments to try to push up inflation and normalize our economies. In the end, nevertheless, showing that asymmetry, monetary policy is in the end effective to fight inflation because it can cool the economy sufficiently to make an impact on pricing decisions. So it's more effective in that scenario, but it takes time. And again, if we look just isolated to the impact of interest rates on business investment decisions, you cannot find really very obvious impact of just interest rates on business investment decisions, which again depend on other variables, again including future growth prospects and then prospects of profits going forward from the investments firms would do. The main investment variable that reacts to interest rates increases is mortgages and housing credit. And it's very unusual what is going on just right now. That in the US, despite the mortgages being at 7% or something like that, there is not yet a very visible cool-off of the housing sector. There was during a period, but there was the rebound in May, and it's still ongoing. So that's very unusual historically, and difficult, by the way, to explain. Really difficult because it's not about the excess savings that were accumulating and are about to disappear in the US and have already disappeared in Europe that can explain such a phenomenon. So, but normally it's the variable that responds most to the increase in interest rates, and indeed the housing sector, including non-residential, also in the same group, is very important to the dynamic of our economies. And if it goes down significantly, it pushes down many other industries. And it's a big contribution to a more recessionary phase, which then will lead to low inflation. But again, it's not working as effectively as it has worked in the past right now. Not so much in Europe, where we have now, on average, housing prices going down. And going down, even in Germany and other Central European countries, where housing credit is done at fixed rates. And which means that the impact of the recent increases is not immediately felt on the payments that all the borrowers will have to face in other countries where the housing credit rates are indexed to more short-term rates. But even in Germany and Central European countries, now the price of housing is going down, showing that there is indeed an effect which will continue and even will be aggravated by the coming recession. So, in that sense, monetary policy in the euro area is being effective in already that cooling off of the construction sector in general, more so than in the US. And that's the usual way that monetary policy can be effective to fight inflation, because then other types of credit, including consumer credit, uh, will also be affected, because consumers will tend to postpone the purchase of durable goods that sometimes they use credit to do, and they postpone, and that's the effect of the higher rates that will not stay as high forever.
Thank you. One potential explanation for the resilience of the U.S. housing economy is, as you said, in the U.S., it's so much fixed rate, and it's 30-year mortgages, so a very long duration. So many people, borrowed money at 3%. And so the rise, now that you can get a mortgage at 7%, it's much more expensive. They said, oh, well, I already locked it in. And in Germany, you said it's a fixed rate, but is it a shorter duration? Because I know the 30-year mortgage duration for the U.S. is actually quite rare globally. And then a lot of countries in Europe, as you said, it's my understanding, have, as you said, variable mortgages. So every single time the ECB raises rates, or every time the mortgage rate goes up, their costs go up.
Well, I'm not sure about the maturities for Germany, but certainly is long maturities. If not 30, is 15 or 20. So that's
Okay.
sure. But what it shows, and it's important also for the case of the US, is that the new demand for new mortgages has gone down in Europe, even if it is fixed rate then for many, many years to come. So the existing borrowers are not suffering so much, but the number of new borrowers for housing has decreased, and so there is no increase in the demand for housing and then for construction. What is surprising in the US is that this new demand for new mortgages is not cooling off as much as it should, with mortgage rates at 7%, and that impacts, of course, the prices, the housing prices, prospects, and the whole prospects for the sector. So it is, in that sense, working in Europe. And right now, not so much in the US, but it will, because that's another thing. The monetary policy takes time to produce effect. And with these rates, and if the Fed continues to increase them, as it seems likely right now, that effect on the housing sector will be the first to be really felt. Of course, in the US, manufacturing is also weak. There is a sort of worldwide recession in manufacturing. It's affecting more Europe than the US, but it's also affecting the US because the PMIs for manufacturing are well below 50 also in the US.
So you were governor of the Bank of Portugal throughout the 2000s. I love,
Yes.
I've read a little bit about just what it was like for central bank's reaction function during the 2008 great financial crisis, and a lot about the Federal Reserve, but I don't know a lot about the sort of European central bankers. What was the sense going into 2007, and how much kind of was it a really big surprise? Just if you feel comfortable,
Mm-hmm. Yeah,
what was
sure.
that period like?
Well, 2007. The crisis was not really in the radar of many central bankers in Europe. Uh, some were more attentive because there were two facts in 2007 that were relevant. Because we already had in 2007 Bear Stearns. We also had the Paribas in Europe that led the ECB to provide a very sizable amount of liquidity all of a sudden to the markets. And so there were already signs of that. There were different views about what was coming. At the time, I was on the camp of those who thought that the situation in the US was worse than even also the Fed at that time portrayed, and that was proved totally right. Because it was not just the 200 billion of the subprime that counted for that analysis. So 2008, everything became clearer, although we have a very we had a very controversial decision, to say the least, in July of 2008 when the ECB increased rates at that time. So that was very controversial, as I just said, because by then the sights of a coming crisis that would come, of course, to Europe also in a big way, coming from the US, but affecting, to start with, the European banks that were invested in many assets in the US, including CDO tranches and so on and so on, that these would be transmitted to Europe, as indeed it did. After Lehman, which came in September. So in October, we totally changed policy then of 2008. But with insight, of course, at least with insight, even perhaps more than that, the increase in the summer of 2008 was not justified at that time. But many institutions also were surprised. Take, for instance, the case of the IMF, that was unlucky in publishing in the summer of 2007 a chapter praising securitization as the big thing that would take care of financial risk in a big way because it diversified investors and everything. And then very quickly after that, we saw what happened to securitization in the US. Of course, it was a general surprise. In Europe, there weren't so many special purpose vehicles and outside the balance sheet, as in the case of the US. So there was no awareness of that phenomenon, which was important, of course, in the crisis. And the so-called shadow banking never had in Europe the expression, the size, the importance that it had in the US.
Right. And a lot of those toxic assets, I'd say most of them came from the US, but they were on a lot of the balance sheets of European banks to a considerable degree.
Yeah.
Is it surprising in retrospect that, given that the epicenter of the financial crisis was US subprime mortgage crisis, that coming out of the great financial crisis, the U.S. banking system actually recovered somewhat. It took a while, whereas the European banking system, I mean, folks can just look at a basket of the
Yeah.
stock market of European banks. It's been quite a struggle. Is that surprising? Again, given that the epicenter of the mortgage crisis was those toxic assets from the U.S. And what might explain that in your view?
Well, what explains it, of course, is that in Europe we went into a second deep recession because the financial crisis made possible that the markets started to suspect that perhaps some weaker countries in Europe would not really be able to sustain the pressure of being members of a monetary union with a common currency, a common exchange rate, and all of that. And so the pressure on government bonds of several countries started to create the risk of so-called redenomination, or to be more explicit, that one or two countries in the end would have to leave the monetary union. And that was this pressure for fragmentation was the cause of the second recession that we started more explicitly in 2012-13. But it started indeed already before when the bond market of several countries were in severe pressure, with yields going up enormously, with all the consequences that had on activity. And some countries started recessions before the general recession of late 11, 12, 13. So that, of course, created a very difficult situation for the banks with this second recession, and the non-performing loans increased also enormously, and attaining the peak precisely in 2013. From then on, they have been going down and now are in low numbers by now, but in 13 it was the peak of NPLs and very bad profitability of the banks and all that. So that didn't exist anywhere else, only in our case, because we had a monetary union of many sovereign countries before, which were sufficiently heterogeneous to start these suspicions and pressures on their national bond markets from the world market in general. So we had very specific reasons for that different development. In a way, there is perhaps two other reasons. One was that the reaction immediately to the 2008-9 crisis did not really lead with the same depth to recapitalize the European banks. It was more difficult because fiscal space was lower already at that time, so it didn't happen in the same scale. It happened later through the market after we stabilized the situation in 15. And now we have the banks with very high capital ratios and a totally different situation in all respects. But it took some time. And the other reason was that as a result of those pressures in 2010-11, fiscal policy became very restrictive in Europe and was had a great responsibility in the recession that we had then, the second recession we had then, late 11, 12, 13. So this also marks a difference to what happened in the US, always more agile to use fiscal policy when needed to stabilize the economy.
Right. And so now in the US, the US had some rather high profile bank failures, such as Silicon Valley Bank, Signature Bank. A lot of that tied to very flighty, chunky deposits and then unrealized losses on their securities book. How would you estimate the health of the European banking system? Would you say, broadly it's healthy, but there are some things you're concerned about? And then also, could you perhaps explain the fall of Credit Suisse a few months ago, which I'm sure our viewers would love to hear your take on?
Yeah. Okay, there is a big difference. In the first place, we apply Basel III criteria to all banks. All banks. In the US, after the change in 2018, Basel III, in terms of capital, liquidity ratios, and all the rest of it, well, not all, but most of it, it's applied only to banks that have a balance sheet over 200 billion. In Europe, we apply to all banks. And as I said, we had in the banking sector very high non-performing loans in 2013. They have come down, and the situation of the banks changed completely. Now we have tier one capital ratios of over 15 on average. We have a leverage ratio which is well above 5 on average, and so it's much higher in many countries. And so the situation is indeed quite solid. Also, we have the liquidity ratios well above the regulatory minimum that is defined by Basel III legislation. So the situation is, in that respect, very different. We don't have the same flight of deposits that is happening in the US. Our broad monetary aggregate M3 is not going down, whereas in the US the M2 is going down, reflecting that decrease in deposits. It's not the case in Europe, perhaps because we don't have so many alternatives to deposits as in the US, including the opening that the Fed did to non-banks to their own reverse repo facility, which allows money market funds and others to place money with the central bank at more than 5% remuneration. So all that has made a difference between the US and Europe. I think it was a mistake what the US did in 2018 by increasing very much the minimum, the threshold to apply the whole of Basel III. There is a potential problem also in Basel III with the issue of the so-called portfolio that can be held to maturity by the banks, where they don't have to mark to market, like in the trading book or in the available for sale portfolios. Supervision has the powers to be vigilant about that, but it's not regulatorily. Banks can do it. And by the way, take the case of the SVB. In my view, from all that I have read, they were complying with all the regulation that was applied to them. It was legal for them to have any size of the held-to-maturity portfolio. It was legal. It was risky, and they should not have done it in the same way, but it was legal according to the regulation. So they were not at fault with the regulation. Also, in their case, because of their size, they had been exempted of reflecting the mark-to-market of the available for sale portfolio into the balance sheet, into the capital account, and so on and so on. So it was, but again, they were complying with the regulation, but they were being very imprudent, of course. That again marks a difference with Europe, where that could not have happened in terms of we apply to all banks, including small ones, the Basel III standards, and the ECB has competence and supervises all the European banks that have balance sheets above 30 billion. 30 billion. The situation right now is really robust, as what the market reaction show in a way prove that they have not been so much under pressure, the European banks, as in other cases. The Credit Suisse was again a different case. The Credit Suisse was a long-standing problem that should have been resolved long before and was not. They were able to inject more and more capital, and those who did it didn't really analyze the situation because they had very low profitability for decades. They were destroying value at a pace that is staggering. Their total capitalization, say 20 years ago, was something like 80 billion or something like that. And when the situation then collapsed, they were at 6 billion only. So it was absolutely staggering what happened to that bank without anyone doing much, and investors continue to provide capital. In the end, the situation after the SPB and others led the market to put a huge pressure on liquidity of the Credit Suisse. And they could not really find investors to increase capital or other sources of liquidity. Well, they had help from the central bank, but it was not enough. So the situation then finally collapsed after a long-standing process that should have been dealt with long before. So that was the very specific case of Credit Suisse.
Thank you. You're absolutely right about Silicon Valley Bank, that it was in complete compliance with the regulations. Its capital ratio was above the threshold, and it was exempted from that additional Basel III. So I didn't know that all European banks are subject to that Basel, and they don't make exceptions for the non one. But do they in Europe, do they allow for the same held-to-maturity duration thing that Silicon Valley Bank had?
It's in Basel III. The text does not put a limit to the size of the held-to-maturity portfolio. That's true. And also, Basel III text does not require a mandatory obligation for the banks to hedge that against bad interest rate developments. So that is the regulation. But there is another thing, which is that all the banks, and in particular, of course, those supervised by the ECB, but not only those, are subject outside of the general system of stress tests. Every year, the banks have to provide an exercise of increasing interest rates by 200 basis points and show what would be the effect, regardless of being held to maturity or not. It's an exercise for the whole balance sheet. And which means that the supervisors are immediately aware, if they would not have done the calculation themselves, but the banks have to do it. It's obligatory. And that, again, it's a difference with what happened in the US. So you don't find at all situations close to the situation of SPB, and all second one would not on the same scale, but it was also affected by that. You don't find in Europe such banks for these reasons. Also, the portfolios that are available for sale have to be marked to market. There are no exemptions, and if there is a loss, it goes directly to the capital of the bank, because it goes to the balance sheet. In the trading book, goes to the profit and loss account. In the available for sale, goes directly to the balance sheet, to capital. So very different, and the US, I think, has to tighten a little bit the regulation of banks that nevertheless are significant.
Very interesting. Well, Vítor, thank you so much for joining Forward Guidance. My final question for you is, you were working at the Bank of Portugal, I believe, during the 1970s. And the 1970s, in the US, we had what we think of as very high inflation, but in Portugal, it was incredibly high. 40%, 50%, you tell
No,
us.
not so much, but okay.
Yeah,
30,
it was that for like one quarter. Yeah,
oh,
it was not sustainably for
perhaps,
that high. Yeah.
yeah,
You
yeah,
tell us the data. I don't know.
sure, sure.
But what was that like? Working as a central banker, where one of your prime goals is to limit inflation, and inflation is so high. And can you just compare that period to now, where people say 6% inflation is high, and it is. It's way too high, but it's not as high as it was in the 1970s.
Well, initially I was working in the research department of the central bank, and it was only in '77 that I became vice governor. So, in a decision-making position, not throughout the '70s. But the main thing in our case was that we had a political revolution in '74. When the military staged a coup to end the colonial wars, and the system started to change from a dictatorship to a democracy. And that explosion, of course, was enormous in terms of unsustainable wage increases. Everything went up. And so the inflation was triggered and fed by that explosion after the '74 revolution. On top of what was happening to oil and everything else in all the other countries, of course. So that explains the very high inflation rates that we had for a while. By '77, they had subsided. They were not at all at those levels, but still high, of course. Well, interest rates were increased. In particular, we had in '78, I became finance minister. And I had to negotiate a standby agreement with the IMF because we had a balance of payments problem. And in that agreement, we had to increase interest rates by 5 percentage points, which surprisingly did not create a recession that was very visible, but corrected the balance of payments.
Sorry, a 5% increase over the course of a year, or in one meeting, or?
Well, in two meetings, it went, yes. Oh, yes.
Wow, those are the old school days. That's how, yeah.
No, it was the result of the standby agreement with the Fed, with the IMF. So that was one of the conditions for the standby. So you see that happened then, and then of course inflation came down. In '78, '79, we didn't have a recession. There was a deceleration of growth, significant, but not a recession. So that's the way we went through the very troubled '70s. In our case, in inflation terms and economic terms, disturbed also by a revolution and a big political change. That it was, of course, very good in terms of having democracy, which quickly stabilized until today. But of course, unavoidably, it had initial social and political and economic consequences.
Well, thank you so much for joining us. People can find you on Twitter at VMR Constancio. And I should also say you are the president of the Council of ISEG at the University of Lisbon, as well as the professor at Navarro University at the Master's School in Madrid. Vítor, thank you so much for joining us, and thank you everyone for watching.
Thank you.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro, or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.